You're watching this earnings preview here at XM.com. Thanks for joining us. We'll be having a look at Netflix, which reports its quarterly earnings on Thursday after the U.S. market close. I'm Christina Marujos, and joining me today is senior investment analyst Marios Hadjikyriacos. So, Marios, Netflix shares have been under tremendous pressure lately, losing 24% since their peak in November. Why is that? And what should we expect when the company reports its quarterly earnings?
Hello, Christina. Indeed, Netflix shares have been under a lot of pressure lately. Now, some of that is company specific, and the other part of it has to do with broader market conditions. So, let me outline both. The first one is we've seen a slowdown in growth rate of Netflix, really. The company was one of the biggest winners from the pandemic, and in the fourth quarter, and really during the entire of last year, as the pandemic started to subside a little bit, people were spending more time outside, we started to see a slowdown in the rate of increase in new subscribers, for example, which is one of the most important metrics for Netflix. Now, the other part of it, which I actually think is the most important one, is rising interest rates hurting stocks with stretched valuations. So Netflix has a pretty expensive valuation. Forward price to earnings is at 41x. The price to sales ratio is at 7x, which are both not particularly attractive ratios. It's a pretty expensive stock. Now, on the bright side, that shows some confidence by the market, right? The markets are pricing in a lot of future growth for Netflix. But it can also be a double-edged sword because when interest rates rise, the stocks that usually get hit the hardest are those with stretched valuations. And the logic is if interest rates are moving higher, investors don't need to take wild chances on speculative high growth stocks to earn a decent return. Now, obviously, Netflix is not so speculative, but it's still quite vulnerable to higher interest rates given its valuation. This week, we're expecting a more or less mixed earnings report. Earnings are expected to have fallen actually from a year ago, and revenue is expected to have increased, but it would be the slowest increase in years, and that would demonstrate this slowdown we were discussing earlier. Of course, what investors pay the most attention to for Netflix in particular is subscriber growth. That's expected at 8.5 million, the same as last year, but double the pace of the previous quarter, and any surprises in this number will most probably decide the initial reaction in the stock.
And with all this in mind, what's the broader outlook for Netflix shares?
Well, I actually think it's quite positive. I like Netflix as a company. It's a well-run, well-managed company with lots of growth potential. It also has a strong moat, so it has a few competitors. Disney and others have entered the field, but Netflix remains the king in content and will most probably remain the king in content given how heavily it is investing in original content. So I think that the long-term outlook is favorable, but I also see some challenges in the near term. So revenue is slowing at a time when costs are rising given all of these investments, and with the Fed raising interest rates several times this year, most probably we could see a compression in the valuation multiples for Netflix shares, which pressures the stock even further, and we've already seen signs of this in recent weeks. So I see a few risks near term, but I'm positive in the longer term, and ultimately this means that patient investors might be able to buy a quality business for an even deeper discount moving forward.
Marios, thank you for joining me today, and thank you for watching this earnings report here at XM.com.